Man, is this market ever gonna move? Somebody wake it up. I think it fell asleep. I was hoping we'd get some flows in around 2 o'clock on the beige book, but not even seeing that. Nothing. Well, it looks like nobody wants to leave the Discord and come join. So I guess they'll catch the replay. One of the topic requests today is from last week. We were talking about the quadrant lines and the Fibonacci's, and of course, having an idea where price should turn, that's one thing. Having an idea of what the turn might look like is another thing. There are continuation patterns and then there are reversal patterns. When I first started trading, I was interested in all the big fancy patterns like the cup and handle, head and shoulders, rising wedges, that sort of stuff. And I mean that it's easy to get excited about those because they're so cool and it's just so weird how they work. And I think they're just really easy for people to remember. And so they're the ones that people gravitate to. But on the intraday, we really don't get a lot of those, or we don't want to play them because they span through previous days because we need a lot of candles to make them. So there's a lot of candles out there. What I've always recommended for people to do is to just start slowly. It's not like you have to learn them all at once. Try to pick one or two continuation patterns and then one or two reversal patterns and just start with those. Once you got it to the point where you know what they are, you know where they're supposed to form, what they look like, and you're comfortable with them, then you can just add to the list, go learn two more, and then two more, and then two more. Because we got the rest of our lives to perfect how we trade, how we can read the market, how we can do things better. So it's not like there's any rush to get them all done, especially if you haven't been using any at all. Then, learning just one would be better than nothing. So there's no best one, there's no right one, no better one. And I've learned over the years that people don't see the things that other people see, right? Like everybody sees their own thing. It kind of reminds me that when I was in psychology and they were talking about criminal investigations and how they had to teach police force officers how to ask questions in investigations because if the officers led the questioning, they could just steer the witnesses into whatever kind of testimony they wanted. And that when you would show up at a scene and ask five people, hey, what did you see? They would all say they saw something different, even though it was, say, like a car crash. Five people, five different witness statements. One would blame one person, one was blaming the other driver, that maybe there was a dog involved or some animal ran in the road. There's all these conflicting and different statements. So we all do see differently. Rather than forcing someone to learn a candle pattern that they might not easily see, I think it's a better approach to focus on candle patterns that we are already seeing. So each person would have to decide for themselves, what pattern are you already recognizing? And do you know much about it? Or do you need to learn more about it? Something like that. And of course, everybody learns at their own pace. So for those people who learn really fast, maybe they'll take more than two candles of each side and they'll do five or seven. It really just doesn't matter. The main thing is that certain candles are supposed to be against the highs, certain candles are supposed to be along the lows. And if we find them in the wrong spot, even if they look right, they're in the wrong spot, we shouldn't trust them, right? Like a morning star reversal should not be found at the highs. It's a bottoming pattern and a reversal pattern from the bottom, from the lows. So if we see one, say here in the middle of a pullback area, then who cares? It doesn't belong there. I wouldn't recognize it and say, "Oh, hey, that's a morning star reversal," because it's not supposed to be there, and we shouldn't use it to try to understand what price is going to do. Building trust in all of this is really where I think a lot of people struggle. And it's not just the candle patterns, it's in all of it. It's in trading. Me, I've got trust issues. So when I started, I joined the Bullish Bears. I listened to what people were saying. I was watching what they were doing, but I really didn't have any questions. I just did my own thing. And if I heard something I didn't understand, I would just go find the answers myself. That's just me. I wasn't interested in asking somebody to explain things to me, and I'm hungry for information, so I would just go out and find my own answers. And so I built trust really fast because I was the one doing the work and finding the answers. And I think where a lot of people struggle is they ask things like, how accurate is this strategy? How successful is this strategy? How often does it work? How well does it pay you? All of these questions that they have. And usually the person they're asking doesn't have the kind of answers that they're looking for, or they're not satisfactory answers. And then, of course, well, now we can't trust the pattern. Yeah, it works for that guy sometimes. He says he likes it, but I don't know. He didn't really seem to have all of the things to say that would make me trust it and believe it. It's not like you don't believe the person. They just didn't convince you that the strategy, the setup, the pattern was good enough, and you don't trust it. You don't believe it. So we have to all find a way to build trust in our ability to see the pattern, see the setup, to analyze the markets accurately, and then trust our ability to trade it. That's a lot. But the good thing is we can all do it, because all we have to do is prove to ourselves that we've got it figured out, right? That we can do those things. So I've focused a lot on building that trust. I like to find a a setup, a pattern, a strategy, and then I just find as many examples of it as I can find so that I have something to study. Just jump over to the web. I'll show you guys a neat little trick when it comes to trying to ask or answer what strategy, what candle pattern do I want to focus on. So if you go to Google, it doesn't really matter what you type in. I'm going to just put in doji. Put any candle pattern you want in there and choose images. This is better than reading an entire book about dojis for me, because I'm a visual person, right? I need to put my hands on it, see it, turn it around like a Rubik's Cube. So If I type in doji, I get all of these examples of a doji. And you might think, oh, well, doji, it's pretty simple. It's just one candle. There's like 15 different kinds of doji out there, right? There's dragonfly dojis and gravestone dojis, and there's all these different kinds. So they're not as simple as just, oh, yeah, just that one kind of doji. But without even reading a book, I can see all of these different ones. And now that I know what it looks like, I can go find examples of that in the past. We know that dojis are supposed to be turning points. So if we see a doji in the middle of a run, doesn't belong there, we know it's not where it's supposed to be. Maybe we lose a little bit of trust in that one. So with this in mind, if I take the same logic that I can go to Google and I can type in whatever pattern I want, what if instead of choosing what I want, I ask for a select group of them, say continuation, like continuation candlestick patterns, so that if I was looking for something that was a continuation candle, this is going to show me a lot of different choices to choose from. And if I don't want, say, a bunch of candles, something like a head and shoulders or a wedge, those are a bunch of candles. Maybe I just want one or two. Something like a tri-star pattern, right? That's three candles tops. And tri-star is a good one to learn if you're using my quadrants, because the three bars that show up on a bullish tri-star, the three red bars, they'll be underneath the 786. So it's awesome, works perfect. Marbozu is another one that's a continuation pattern, and it's really easy to see. So just by typing in continuation, I can scroll down and I can see all of these different ones. A quick tip, by the way, if you do this, if you go to Google and type in and you're looking at it the way that I'm looking at it, you're going to be tempted to just click one of these pictures because it seems to be something that you want to look at. Be very careful here. All of these go to a different website. I don't know about you, but I'm not interested in, ending up in a nasty website that maybe infects my computer with some trash, or some place where they you know want to try to sell me something. So look at the name of the link before you click on it. I know that's not 100%, but it will help you eliminate a lot of the circles out there, right? So TradingView is a safe one, or safer. You got Bullish Bears. There's you'll find things from like Fidelity or Schwab. Sure, click on that stuff, right? If you don't recognize the name or the community that it belongs to, just don't click on it. That way you don't, go and get into something that you shouldn't get into. So these are continuation candlestick patterns, which, by the way, you can go to AI and just ask it the same thing. Hey, give me a list of continuation candlestick patterns by name. And then you can type those names in this list and get the visual of what it looks like. And then we want reversal patterns. It's pretty simple, right? So in today's discussion, we're going to talk about reversal patterns. I've got my favorites, but just because it's my favorite doesn't mean that it's the best one out there or that you have to use the one that I'm using, right? Because there's no best one, there's no right one, there's no better one. There's just which ones do you know and can you start using it? So last week we talked about the quadrants giving us these levels: half, 786, 100, 111, 1236. So we're talking about when price gets there and we're looking to see, hey, are we going to continue through that level and keep going? Or are we starting to turn around and we're going to go back the other way? It helps if you've already got an idea of what continuation looks like versus what a reversal looks like. So some of my favorites on the reversals is a morning star and an evening star reversal. This is an evening star reversal, right? It's bullish that reverses. The morning star is bearish that reverses. So at the lows, you're turning to go higher. At the highs, you're turning to go lower. There are some nuanced pieces to this, like it's supposed to have a gap. The bar in the middle is supposed to be one of these spinning bars, but as you'll find over the years, you start trading this, it doesn't have to be perfect and concise. And a lot of times it won't be. It's going to look vaguely familiar, but it won't match what you get in the textbooks, right? And that's the way it is. Like you just got to get to the point where you're comfortable with some sort of slim shady version of what you were expecting. So instead of a spinning bar, maybe it's a doji or even a Pinocchio bar. As long as it's still forming that 3-bar reversal, and maybe you get the gap down, maybe not, especially on the intraday. You know, we don't really get those gaps on the intraday as well as we do on like a daily or a weekly. So when you're trading this on the intraday and you're looking for that gap, you're going to be disappointed a lot. So what? We're just not supposed to call it an evening star reversal because we didn't get the gap? Nah, I'm not willing to do that because it's a really good pattern and I like this one a lot. So I don't care that it doesn't have the gap, right? If it does, great, I'll take it. But on the intraday, a lot of times you're just not going to get that gap. And so what? Right? Doesn't matter. Now a swing high looks exactly like a 3-bar. I guess we could argue they were named in different generations and that they're really just the same thing. A 3-bar reversal doesn't need the gap. They literally look exactly the same, but they don't need the gap. And in fact, the 3-bar can be more ugly than the evening star. These evening star pictures, they're all very pretty and uniform and clean and just so nice. But a typical 3-bar swing high, it can be a lot uglier than this. And we would still recognize it as a swing high, especially a 3-bar swing high. So we don't need to dig too deep into it and try to haggle with the name. Is it really the 3-bar swing high, or is it the evening star, or is there some other name that I'm missing that it should be? Who cares? As long as we recognize that it's a reversal pattern, then we can play the reversal. So all of this is a process. First, we get used to using the fibs and the quadrant lines, where to snap them, how to adjust them, where the levels are, where we expect price to go. Then price gets there, and we're trying to figure out at that point, okay, we reached the line. Are we expecting to go through it, or are we looking for a reversal? If we have an answer before price gets there, it will be better, right? Like getting to the high today, the high of yesterday. Let me just wipe some of this stuff off of here. We don't need any of this stuff. I now want to mark out yesterday's high. That's yesterday's high and yesterday's low. You don't see it because I turned the one off. I'll just turn it back on. It was in my way, so I turned it off. So there's yesterday's high, yesterday's low. There's our breakout, and I was looking for 111 today, right? Now we're hitting the intraday 111, but I was looking for yesterday's 111, right? And my expectation today was, well, if we do break out and we do go up here, I'm looking to fail that and come back down. That was my argument all morning, even when we were still way down here this morning. If we got to 10111, I was expecting a reversal. So I don't need to wait for the candle pattern. I don't need to wait for bonds and yields and dollar and I don't care. All of that stuff. I already had a plan because I already had a bias. I'd already done my analysis. My base case argument for today was probably wasn't going to do anything. Sideways day. And that if we got a breakout, it would probably fail. And that breakout would lead us back inside the box. The failure very likely is going to be a 111. So now that I've got my bias, I've got my line, my level, my target, all I need is for price to get there and show me the reversal signal that is confirming what I already was expecting. We don't have to have that bias, but it sure helps. Because if I don't know what it's supposed to do at 111, say I wasn't sure today was going to be a sideways day. Who knows? Maybe I just couldn't figure it out. And believe me, those days do exist where I just have no idea what we're supposed to do today. Then we're stuck waiting still for price to get there and show us what it's going to do. Give us a continuation or give us a reversal. Now, at some point, everybody gets hung up on, but when am I supposed to get in? Well, if you're trading with a candle pattern, the pattern isn't formed until all of the candles for that pattern are closed. That's really important to understand, right? This is a 3-bar pattern, and until that red bar is closed, you technically don't have an evening star. You've got an evening star in the making. It's possibly or very likely going to close as an evening star, but it's not one until the red bar closes. So maybe you wait. There's nothing wrong with it. I don't like to wait because I'm not looking for confirmation that this is truly going to be an evening star. While that red bar is alive and price is moving up and down, I'm very likely going to go ahead and get into the trade. But you have to look at your rules and make that decision for yourself. What happens if you get in and you didn't wait for the candle to close? You don't have confirmation, so you will very likely lose more often. That's the truth, right? That's how it works. I don't care. I'm not keeping score between winning and losing. I care about how much is at risk, how much am I going to lose, how much can I make? And with every trade I take, I'm trying to lose less money. And when I win, I'm trying to win more money. So I don't care about keeping score and what my win rate is. But that will be the consequence of jumping ahead of a trade that is not yet confirmed. That is just a fact. You will lose more often. For my style of trading, I say, so what? I don't care. But you have to decide that for yourself. If you wait, you get confirmation. So you will lose less often. But the losses that you take will be bigger right? You will lose more money on the losses that you do take compared to my losses, which are smaller because I didn't wait for confirmation. It's not right. It's not wrong. It's not good. It's not bad. It's you choosing which one of those you want to do. And you're not stuck with your choice. You can do one way and then do one another way and rotate back and forth. You can just choose whatever suits you at the time. There's nothing wrong with any of it. But you can't look to somebody else and say, "Will you tell me the proper way to trade this evening star? Am I supposed to wait or can I get in early? And if I get in early, when? Where early? How do I do it?" There is no wrong way or right way to do it. There is just doing it and then deciding, did you like that outcome? At some point, I had somebody say, "Well, I figure you can tell me when to get in so that I'll know that it's going to be a winner before I get in, or that my trade will be a win because I waited or because I didn't wait." Yeah, well, it's not going to work that way. If this reversal is a failure, price is going to go higher, right? We're talking about the evening star. So the one that was going up and is now going down. If that fails, price is going to go higher. And it won't matter when you got in, your trade will be wrong. Whether you waited for confirmation or you jumped in early, none of that's going to matter because you're still going to lose. So you just have to decide how you're going to enter it. Same thing with any other pattern out there or no pattern at all, the trade triggers that we use. So this is one reversal that I really like, the evening star and the morning star. And it looks very much like a swing high and a swing low. The difference is with the swing high and the swing low, it unless you specifically say 3 bar, it can be more than 3 bars. This is a swing high reversal pattern. This is a simple 3 bar swing high, but they don't have to be. A lot of times, this one right here is one that I've shown quite a bit. It can make up 5, 6, 7 bars, and there's actually a counting system that goes with it. I think the counting is just screwy, but there is that. And it's basically just a collection of candles where we turn and we go the other way, right? No right way, wrong way, good way. It's just a swing low and or a swing high, which is a really, really good trade setup because of this weird thing that happens um, after a swing low or swing high. We get wicks on the opposite direction. So if it's a swing high and we're going down, the bars that are going down will leave upside wicks behind, which is really helpful for that question, should I wait? Here's the very first candle automatic sticker that I ever made, right? Most stickers that I've made, they're just an image, they don't move. But I made this, and it's one of my favorite trades, right? So I had to draw it out. Wasn't that hard since it's one of my favorites. It's a morning star reversal or a 3 bar swing low. Doesn't matter what we call it, right? It's one or the other. But I really love this trade. So when price gets to yesterday's high or to our 111 and we're looking for that reversal, that is a really good reversal to look for. We don't always get it, or we'll get it, but it'll be in the middle of the night and I'm asleep and I don't get to trade it, or it'll be between 9:30 and 10:30 and I don't want to trade in that window, so then I miss it. All right? So even when we get it, it doesn't mean I actually get to trade it every time, but it's a really good one. What we've had today is these 2 bar reversals. Like They're kind of like a tweezer top, but neither one of these are a tweezer top, right? They're just kind of like a tweezer top. There's too much wick on the top of this one, and the bottom of this one had wick, right? It's just, it's not a tweezer top. A 2-bar reversal, maybe, but still, these are reversal patterns. So, how do we gain trust in our ability to spot these reversal patterns and all of the different styles that they make up? It's the same way I showed how to build trust in a 111. And this works for anything. If you wanted to use MACDs and stochastics and RSIs, then, the same thing that I'm going to show you, you could use it for that. It's anything. Set your chart back so that you have something to look at, something to examine. I just put 180 days on a 5-minute chart. So I can scroll back all the way to August of last year. And I can start looking for reversal patterns or even just days where we reversed. So here's August 11th. 2025, and we had this really beautiful afternoon reversal right there. Now, earlier in the day, we had built this down here, which I see a lot to that, right? We've got this big bar here on that drop. So it looks like data or some headline or something came in, gave us a big drop. Price got stuck underneath the mid, finally broke out, came back and checked old resistance as new support. So a little micro Busby in there. And then away we ran all the way back up to the high of day. And then we had a blow off top. It doesn't quite look like it was right on the money. I thought maybe it was going to be right at 12, but it looks like the 1205 bar, big blow off top. We flip and down we go. Now, there's no great way to trade a blow off top bar or a capitulation low like we had down here. That's a capitulation low bar. There's no great way to do it. But one thing that I like to do is snap that midpoint. And we can see price got stuck on that midpoint before it finally broke down. The same thing we can do down here, right? When we had this capitulation low, snap the mid and see if we can get price back through it the other side. The problem is when we're stuck inside the candle, this is the danger spot. Anywhere in here is danger, anywhere. But once we start building that midpoint and it shows us this, now we've got a trade trigger for a breakdown. I don't know what we would call that other than it's a bull flag that failed, right? But it's not a 2-bar, it's not a 3-bar, it's not even one of the complex topping patterns because of the way we got there, right? So it's like a news bar. But once we got stuck on that mid and we were holding the line, all we got to do is break that down and we're on the run, right? Exactly. It is. Like this one over here, this one is dangerous. But this one wasn't dangerous because of that mid bar, that midline. But in a situation like this one down here, it's a lot more dangerous. And this one can cause a lot of trouble, right? So the best way to learn about this stuff is you set the chart, go back in the past, find reversal patterns, and then try to develop a recognition for it. I know this one, right? It's a blow off top reversal bar. I recognize it really well. I can take a picture of that, dress it out, put the lines on it, mark it, take a picture where you can see yesterday's range so you can see what you're breaking out of. And that would be one kind of trade right there, right? That's one kind of reversal right there. There's a micro range 111 reversal right there. This is what we're measuring. Price ran back up, checked the 111 and failed, came back in again. Now, don't get me wrong, we had a nice reversal down here, but we also had a nice anticipated, expected reversal up there. So, yes, it'll help if you have all of these named reversals. But as you're going to find, a lot of times price is going to break the line, it's going to break the level, it's going to go above where you expected it to go. It's not going to give you a good clean pattern, and you're still going to have to try to figure out, is that reversing? I Yeah, but I mean, like, if you get to the point where your eyes are seeing the 50 or you're kind of close to the 50, it's good enough. You know what I mean? Like, I use the midpoint of bars all the time. I don't necessarily snap the line. You know what I mean? Because I kind of see that line. I kind of see the midpoint. It doesn't have to be perfect for me, especially if I'm trading it and I'm kind of in a hurry. You, you know what I mean? Like, you just, as long as you know it's there, because it's not to the tick perfect, right? So when we don't know what price is supposed to do and we're sitting there waiting on it, that's not necessarily a bad thing. Let's put this one back up, because this one, it didn't even get to the 111, and I think that's a good one to cover because that happens a lot. You're waiting on it, it looks like you're going to get it, and then look at that, it doesn't even get there, and it starts to reverse. And then, well, what are we supposed to do with that? Do we trade it? Do we not trade it? Stick to our guns and wait? It didn't get to our line. Well, if you had traded it, you didn't get much, and it was only what, a 7 point move anyways. It didn't have a good starting point. It didn't have a good follow through, so we never really had a good shot at it in the first place. If we measured this one from earlier, same thing. We didn't get to the 11 reversal, and now this one was a better reversal for sure, but there's no perfect here, right? So it doesn't hit our level. What are we supposed to do? Well, it broke the mid on the way down. That can be a trigger right there. Is it enough? I mean, you'll find plenty of examples where it breaks the mid and then it keeps going higher. So nothing's perfect. But if it reversed at a 111, or it reversed where I had expected a reversal, and we can break the mid, I'm willing to give it a shot. But time of day matters. If I had seen that at 9:45 in the morning, no, I wouldn't have traded it. If it happened at 8:45 in the morning, nope, I wouldn't have traded it, because I don't trade that window, right? If it happens in power hour, I probably wouldn't trade it. 2 bar, 3 bar, complex swing high, complex swing low. Those are all really good reversals. Morning star, evening star, hanging man, and hammer. All of those are good ones. I'm going to post some in the chat here. And on that list, the morning star and the evening star are my favorite. It's worth learning how they look for sure, but also going in the past and finding them as much as you can. Find them on different time frames, find them on different markets. Get as comfortable with and being able to read price will come from this, right? The analogy is think about how you literally learn to read. First, you learn letters, then you put those letters together and you formed words. You had enough words, you put them together and started making sentences, strung those together after a while, and you were making paragraphs. You put the paragraphs together, you had a chapter, right? It just kept growing and growing and growing. Well, learning to trade or learning to read price is no different. Start with 1 bar and 2 bar patterns, learn those, and then start adding in more complex patterns so that after a while, you're reading price as it's unfolding. I do it all the time. The problem is you're going to get price that there's just nothing there to read. It's like somebody shook a bowl full of letters and dumped them out on the table. It doesn't form sentences. So you just get to the point where you're like, yeah, that's nothing. And then you don't trade it because there's nothing to read. Of course, the good side of that is when you have something to read, well, you can read it. I was talking to somebody yesterday about doing this kind of work, and they said, well, this is a lot of work. What's the shortcut? I wish there was a shortcut. And yeah, it's a lot of work, but it doesn't cost you anything. You don't have to buy anything. You don't have to subscribe to anything. There's no book to read. You just have to go in the past, look at everything that you can look at for a reversal. I just grabbed, I don't know what this is, CPI, PPI, non farm payrolls. It's one of those. That's a really nice liquidity gap, or what I call an event bar. That's a really good one. What I don't like for a gap close bar is this wick up here. I wish that wasn't there. But otherwise, that's a really nice big event bar. Well, I measure those event bars. I like using 111, 1236, and 1.5. Those are really important, the 1.5, because these are so violent that when we break out of them, we often get a 1.5 or even a 2.0. So if you are measuring violent bars, just add that extra line on there, right? That 1.5 and maybe a 2.0. We didn't get that breakout on this, but if we had, that's very likely where we would have went. So we got a reversal, and then over here we got another reversal. Both of those are really clean, and they happened where we could have expected a reversal, right? Right off the 111. Nice reversal. I didn't check, but it looks like the low end might also have had a reversal. Right after that candle was made down here. Yeah, it's not good, but yeah, eh. So we know we can measure event bars. We can measure Globex range, yesterday's high and low, last week's high and low. Really anything can be measured. right? We covered that last week. And look at that. We finally did get the expansion in the next day's Globex, and we ran up and we tagged the half. I guess it kind of proves my point. Now there's a trade pattern concept called drop base rally or rally base drop. Let me find my notes on this because this has drawings that you can add to it with specific rules. And sometimes it looks exactly like a swing low or a swing high. And so not only is it recognizable, but it has rules for where your lines get drawn. And so it can help you approach your analysis in a more consistent way. It's not my logic, by the way. I'm hunting for it, but I'm just gonna keep chatting while I'm looking. This concept was built long before I ever came around, and that's what it's called: is drop base rally, rally base drop. It ties into a lot of supply and demand stuff, which for anybody who's been around for a while, that's not my language. I don't use supply and demand talk. I think it just confuses traders. Yeah, there's drop base drop, drop base rally, rally base rally, rally base drop. So you are right. And we kind of have one here where we dropped and then we based and then we dropped some more. So it doesn't have to be a drop base rally. It can be a drop base drop. That's exactly right. Examples. That's what we're looking for. So I grabbed these um, back in January of 2023. I had the Globex high marked out, and you can see that we were struggling with that from the 9:30 open. We just couldn't get through it. And then we dropped down and we set this really beautiful low. I mean, look at that. That is such a beautiful 3-bar reversal. I would call it a morning star, but it doesn't have the gap. But it's a really beautiful reversal pattern right there. I mean, that's what I want to find. Of course, we don't get that all the time, right? We end up with something that looks like this junk over here on the left. But when you get it, take it, right? Like that's a really nice pattern. We had the same thing right here on the Busby. This one isn't as good because that middle bar is so wicky, but it's the same concept. And it was the Busby from the breakout. So it wasn't just some random line in the middle of nowhere or a random reversal back higher. It's a Busby pattern. So just a little deeper than it should have been. Intraday high, matching intraday high later in the day. We overshot it in a beautiful rejection. And look at that bar down. That is also a really good setup. But on that one, I don't like to wait for this candle to close. I like to get it when it breaks at the very least. This is my latest entry right there. Getting through the mid of that bar would have been better, or at least getting through the mid of the body, ignoring that wick up there. I'd have much rather done that. But even if it's moving fast and I don't get any of those, there's still the chance to get in as it breaks the low and it's doing that, right? But that's a nice reversal pattern. And yeah, in this example, you could have waited and let the new bar open and jumped in. You could, but a lot of times you'll get that kind of a move and it's going to close down here and it's just going to go right back up again. So at least this way you could get what, a point and a half, 2 points, better than a loss. You pay your commissions for the trade, you're out of it. And that way, if it runs back up, so what? You didn't lose money. But that's a really nice reversal. Classic reversal down here, trash. And that's why it's a classic, because you're going to get it all the time. Get really used to something like that because it's the kind of trash that we get, right? There's just nothing you can do with it. At least there's nothing that I want to do with it. If it fakes you out and you get in, so what? Get back out, try to minimize the loss. You take a 2 tick or a 3 tick scratch, you're out, and then you're waiting for a better setup. Something that looks like one of these others, right? Same thing, trash. Now, is it tradable? Yeah, of course. Anything is tradable. We can look at it on a different time frame. We could just, jump on there anyways because the wick had set the highest point. So we can do it, but there's no signal here that says that that's a trade. None that I know, other than it's just a bunch of bars across the high. It's not a swing. You know what I mean? It's nothing. And you're not wrong. You had the same thing back here, right? Fighting a level. Now that's awesome, especially if you bring in the dome, right? If you're watching like the active trader, the dome, the tape, and you're watching that battle play out in the time and sales, that's awesome. But a lot of people are struggling just to see a candle pattern. So I wasn't even getting into that. But you're 100% right. This, like I said, it's tradable, but there's no pattern here. Time and sales and the active trader and watching the battle play out and using the tape, you could easily trade that. But if you're looking for a Marbozu, an evening star above the belt, a tri-star bullish, it's none of those, right? It's no pattern. that is that is your um, distal line, and the top is your proximal line. Or I got that backwards. The top is your distal line. It's the most distant away from you. And the line on the body is your proximal line. It's the one closest to you. It's in your proximity. Distal and proximal. If you oh, what happened? Oh, I jumped a. If you go to anything that digs around in those drop base rally um, PDFs or books or anything that you might have run across, they'll cover that in those books. See, I've got something on that somewhere. There we go. Proximal line is closest to you, and distal line is the spot farthest away from you. So the lowest or at the highs, the highest wick point. Now the proximal line can go in three places. Where you choose gives you a zone. So you can see like the distance here, it's kind of wide. If we choose a different location for that line, Here, it's even wider. We're using the highest wick point and the lowest wick point. And then here, the lowest body point and the lowest wick point. And that's the narrowest zone. This one would afford you the least amount of opportunity, but the higher conviction trades, right? It's quality over quantity. So, of course, the wider the zone, the more chance you'll find price there later. And it'll be sloppier, harder to pinpoint your play. But a narrower zone, price won't get there later as often, but it'll be a more exacting target. So these are just various line placements for where do I want to draw the proximal, where do I, the distal is always the same spot. It's the farthest spot away. We don't need those words. You know what I mean? Like it doesn't matter if I know the proper name of the line. It just matters that we know what to do with them. So if you never heard these before and you're like, "Oh, that's so cool." Well, cheers. I thought it was cool when I learned it. But knowing that those names aren't really going to help us out, right? Just how we can apply them. So here's a really sloppy version. And instead of using the lines, I drew a box and I did it for a purpose. I wanted to show how these things can overlap each other because the argument at some point starts to come in of, well, which one of these boxes am I supposed to focus on? This zone back here was the first one, and then we went through it. Do I take it off? Do I leave it on? Now we got another one. Do I take that off or leave it on? Now we got yet another one. So these zones can nest within various price patterns. And of course, if we drew them on different time zones, then they may have their own effect as well. But as I said, that's the supply and demand stuff that I think just confuses the hell out of people. And I don't often use that language. Ignition bars, Marbozu bars, belt hold, evening stars, morning stars, hanging man, hammers, harami, doji. All of those can be considered basing candles. These would be leg bars or leg candles. OCR, one candle reversal. There's an entire technical analysis style called OCR. It's new, all things considered, probably a decade, 10 years at this point. That's pretty new compared to a lot of the candle stuff that's out there. And I don't know, it doesn't seem to really be growing in popularity because when I mention it to others, they're like, what's that? I never heard of that. Well, I mean, I didn't make it. So I learned it, but I just don't see anybody else really get into it. But if it is a one bar reversal, like a doji is an OCR. So one candle reversal, or a hammer or a hangman. Those would be one candle reversals. If you think about all of these bars and the way that they're formed and the way that we're going to get into them, once you've got a pattern, whether it's a 2 bar or a 3 bar, whatever it is, you can start doing the lawyer's argument for how do I want to get into this thing? Because remember, you're going to see it again. These things just repeat over and over and over again. So you can find something that you want to trade, some reversal, and then start making the argument. How do I want to do it? Do I wait for the candle to close and the new one to open? Do I wait for the wick to form? And you can lay it all out and then do it on the next one and the next one and the next one because you're not trying to necessarily write down a set of rules. I don't know about you guys, but I tried that once and I was trying to read my rules and missing trades, right? Like I couldn't keep looking at the list of all the things that I was supposed to have for the trade and be able to get the trade on. It just didn't work. But if you take a picture and you mark out how you're going to trade it, and then you find another one that matches the same setup, and you take a picture and you mark out how you want to trade it, and you do it again and you do it again and you do it again, you teach yourself how you want to trade it, right? It gets to the point where you've got it figured out. So then you can go to paper and you can actually start trying to trade it live to see if you're following the rules that you had already put together. Typical classic reversals, right? And none of them are pretty. All three of these, the low that we set early in the day, and when we came down and revisited it later, there's no classic two bar or anything like that, right? They're just ugly reversals off a key level. It was already the low of the day. We overshot it, came back up and closed on it. We overshot it, closed underneath it, and then came right back up above it, right? These are two very common reversals. So if I wanted to trade this reversal, one thing that I could really focus on is finding examples of this and then really figuring out, hey, what's a good way to trade that? Which, by the way, guys, I don't trade that because I have never found a good way to do it on this time frame. Now that's a bear flag failure right there, and it got stuck on my 786. Now once it broke the 786 and it buzzbeat off the bottom of that 786, there's an entry right there. Other than that, no. This reversal over here, nothing. It was just big wicks, lots of trash. There was no tradable signal there. This one was, but we would have had to have known that that was the low of the day. We didn't have, like these two were reacting to this pivot. This pivot wasn't reacting to anything that I have marked. So it wasn't like the low of yesterday. We can see where price came from. So whatever caused that reversal, we weren't even probably anticipating it. Find as many examples as you can find and then really start to dig in. How am I going to trade this? What you're going to find out is there's only so many ways to do it, right? You wait for the candle to close. You don't wait for the candle to close. One of my classics is breaking down through the reversal bar. So that's the reversal bar. The new bar opens. There's no wick on top of that at all. That thing just opened and dropped. Cutting through the reversal bars low is an entry right there. This reversal was a part of this that we had already had marked. Later in the day, we had this reversal. It's a lot uglier, but it's reversing at a known reversal spot. The pattern isn't that great, but it closed below the 50%. The new bar opened. We got that wick that rejected better. Down we went. The slowest entry I have would be breaking below the low of the reversal bar. I like that one. I use it quite a bit. It's defendable, and if you're thinking, well, where do I put my stop? Use either the body of the reversal bar or use the midpoint of the reversal bar. It works good. You don't have to draw a line, and snap the midpoint and get the stop just perfectly in the middle. I mean, I tried that for a while. And what I found is sometimes I'd be fiddling with that damn drawing and price would come against me and I would get triggered out of a trade or my loss would get bigger than I wanted it to be because I wasn't sitting there watching the dome and keeping my eye on price. I was fiddling with that damn drawing, trying to figure out where the midpoint was to put my stop in the right spot. And you know what I mean? It isn't worth it. So just eyeball it, get close. You can move it on the dome anyways, or move it on the chart. for me, it's better to get out of the trade before it hits your stop anyways, so I will. This one or this one? Yeah, absolutely. In fact, these will oftentimes take me out where I get in here and price drops down and the new bar opens and it starts coming against me. I get out. I don't care. I'm not trying to get all the way down here anyways. I'll take it if I can, but if it starts to challenge me like that, say I've only got one or two contracts, especially if I only have one, if I'm running, one lot warrior, that bar will take me out because I won't give back all that profit and I won't sit there and wait to see if it's going to run up and hit my stop. I will get out. See, that's a really good question. And I think that's where a lot of traders struggle. They get in with the idea that they're aiming for, at the bare minimum, the low of the day, right? That's a fair target. It's an absolutely fair target. So they get in up here, things are looking good. This bar closes, the new one opens, they start getting challenged, and then, oh, hell, what am I supposed to do? I got in to get all the way down here. So what do? They defend it. They end up getting out of the trade. It goes down here and they get mad and frustrated. If I'd have just stayed in, why did I get out? It worked. I should have just left it alone. I shouldn't have messed with it. I don't have that problem whatsoever, not even a tiny bit. My money is mine. I want to keep it. This sort of behavior, even though it all worked out, that aggressive push back in the other direction, as far as I know, looking at everything else we've had that day, this reversal's coming right back up and it's going to break out and run. I don't know. You don't know. I'm taking my money off the table. Gimme. At the bare minimum, I close it down, it wicks back down and closes right there. I can jump right back in with a whole new trade if I want to. All it has to do is break the low of this bar right there. Fine, I'll do that. Not saying that I would get right back in, but that's certainly something I've done before and I'm willing to do again. And I would rather do that than just hang on and give back all of my gains, hoping that it doesn't hit my stop somewhere up there, hoping that it's going to all work out and give me down to this low target that I was aiming for. Because hope is a really bad trade strategy. Now, if I've got multiple contracts, then sure, take some off, make sure that my stop is in profit so that if I do get stopped out, I'm only going to get stopped out with like 2 or 3 ticks of profit. That'll pay my commissions off and I'll let it ride because so what? The worst that happens is I only make my commissions. I already took profit down here. I've got a runner on. We'll see how it goes. And in this scenario, my runner would have gotten kicked out, right? I would have still got kicked out of that trade. Because if we got in as it broke that low, then my stop would have been on this side once price was down here. And I would have gotten kicked out of that trade. Stocks, options, futures, when I trade like this, it doesn't matter because they're all the same. Now, to be fair, when I am trading options, I'm only this strict if it's the SPX. If it's anything else, I guess I shouldn't say that. It really, if it's Nvidia with its $2,400 options, I'm still going to trade like this, right? So if the options are, a couple $100, like a SPY option or a Q option, I'll be more lenient because I'll probably put it into a spread or, do something like that. If I'm trading a naked option like SPX naked or Nvidia or something else that's thousands of dollars per contract, I'm going to be this strict. I'm not giving any of it back. The cheaper stuff, I'm willing to let it ride because it is an option and I've got choices. I can roll it, defend it. But on those, I know I'm willing to do that before I even start the trade. That way I know, should I use a 0 day today or not use a 0 day? If I'm not going to defend it, why not use a 0 day? But if I am going to defend it, then I don't want to use a 0 day. I need something with some time left to it so that it can be defended. Options have so much more choices to it, right? You can just put them on and hope for the best. It has a fixed loss, 50 bucks, whatever, 100 bucks, and you just let it ride. And so what? Let it do what it's going to do. Futures or very expensive options? Heck no, I ain't doing that. I'm going to defend it, fight it, close it. Yeah, if it did stop me out, like we were talking about, there absolutely is another entry. One, you have the big bar, right? So there's the mid of that one. Once it stopped us out and started to fall, when it fell back down through the mid bar of that big bar, that's an entry. Or if you're still in like shell shock, like damn it, it stopped me out and we're frustrated and we miss it and the bar closes down here, let it cross the low of that drop down bar. Let it cross that, right? So you'd be getting in somewhere in here. You know what I mean? Like you still got a shot just because you got kicked out. The thing is, a lot of times I probably won't. You know what I mean? Like I want good, clean setups, and I'm picky, and I'm here all day, which I got that advantage, right? A lot of people only get to trade for their lunch, or they only get 30 minutes before they have to take the kids to school. You guys might not have all day. I have all day, so I can be really picky. Plus, I get most of my trading done before 7 a.m. All this afternoon stuff, it's all gravy. Anything that I get past 7 a.m. is just extra money. And so I can be really picky. So that is another way to get in, but me knowing me, I probably wouldn't do it. I have done it, especially if I get salty, pissed off, frustrated, and then this isn't a revenge trade, but I would see it that way. Getting back in anyways, just because it spite me and took me out there and made me mad. And it's a midpoint play too, right? You got the low of the day, you got the high of the day. There's the midpoint between those two distances. So we had already broke the mid, closed below it. This was just like some kind of stop hunt meanie tactic, and then down it went anyway. So you still had a chance to play it. Yeah, and that big bar, any other day, that big bar I would say could fit as like a liquidity thing. But in this picture, look at all of this really nasty stuff. Like there's big bars everywhere that day. I wish I remembered what was going on that morning when I took this, because this is some really nasty drama, right? All things considered, it's pretty ugly. Yeah, there's your 786 right in there. So it had already broke down, and on that retest, it looked like it never got above 786 before it headed right on down. And then of course we had our mid, which was not that low. The mid was like up here, and it was clearly below the mid. There was a lot of reason to stay in the trade. The thing is, I won't. And have I? Yes. Will I do it again? Oh, I'm sure I will. But on average, if I run into this situation and I've got this sort of bar coming at me, I can tell you guys right now, I know me, and 9 times out of 10, I will close my trade somewhere down here rather than let it come up and challenge me, because I don't care if I get here or not. I want here. That was the goal when I got in. But when you have 10 contracts, 12 contracts, 15 contracts, and you take a trade like this, let's see if your answer changes. When it's one or two contracts, sure, why not? Whatever, right? 2 points. What's the worst that can happen? Sure, try that with 15 contracts and see if you tell me the same thing. Because that's really where a lot of my answers started to change. When I sized up, I really had to start making different decisions. Do I want to give back 3 points of profit and break even? No, but I would rather do that than give back 4 points and take a loss, right? But on top of either one of those, can I just give back 1 point and keep the other two? Thank you. I'll do that because 2 points and 10 contracts, I'm good. Thank you. I'm going to go get some coffee, right? It's a good morning. So when you get a really good outcome and you do get back to the bottom and you was able to fade 15 contracts through that run, then you've had an excellent morning, right? And that's the difference. I'm just not willing to compromise that. And until this decision is made inside of every one of you, you'll continue to fight with it. And I know the fight, right? You get out and then you curse yourself for the rest of the day and you'll go back and examine it 50 different ways trying to figure out, why did I not stay in this trade? Look, it made it down there. And you'll go and torment yourself for the day, 2 days. I should have stayed in it. Why did I let it get me out? Look at all that I could have made. And on the other side of that, you're going to try to hold it and it's going to wick down here and run right back up, break highs, and go even higher. It's going to stop you out with a loss that you certainly don't like. And then the argument's going to be the other side around. Why did I not close this sooner? My goodness, I should have got out. What was I thinking? And you just go in a circle. I gave up on that circle a long time ago. So the idea is, find as many examples as you can find and study them. Try to lay out a consistent idea of how you want to get in, and you can write it down if you want. I tried that, it did not work, but that's me, right? I use pictures. I literally took a picture and I drew all over the darn thing just like we're doing right now, and I marked out the levels and what I would do, and it was all in the image. And for me, that sticks in my brain so much better than writing it down on paper with words and sentences. Once you're done with it, start scrolling the chart, find another example, take a picture and do it again. Find another one, take a picture, do it again. And for me, it didn't take long. I had that thing memorized. I knew exactly what I wanted to do with it. Then all you have to do is go out and trade it, preferably in paper, so that you can see, hey, do I like this or does it need to be tweaked a little bit? You probably won't get it right the first time. You're probably going to need to tweak the system and then try again, tweak the system and try it again, right? There's nothing wrong with that. You grow as you learn. So run the system with what you have. And then when you learn something new, go back and adjust the system. For every new candle pattern you learn, you'll have another way to anticipate that reversal. Now you can bring in the dome, the active trader, whatever you want to call it, bring in the tape. It is helpful, but not all brokers have it. And then depending on the data package that you have, it might not help, right? So I don't want to dig too deep into that. Just recognize that if they are fighting on the dome and you've got at least 10 lots above and below, you can see them trying to fight it out. Depending on the broker you use, like TradewithKev, they've got really good tools built into TradewithKev. TradewithKev was connected to Jigsaw. They were partners. And so TradewithKev looked at what Jigsaw was offering and built a lot of their software into their platform. I don't know that that's why they're not partners anymore, but they're not partners anymore. If I was partners with someone and they stole my stuff like that, I probably wouldn't be partners with them anymore. So I am going to paper. You can see I logged in there on paper. If you see me trading anything, just realize I'm not risking anything. This is just paper. So if you've got your lines, you've got your levels, your pivots, you got price coming down into it, you can watch the tape and you can watch the dome to help better understand what price is doing. On the dome, if we're going to go up, the NASDAQ, by the way, sucks. If you're going to try to use the tape, that might help, but not the dome. The dome is already so thin, you can see it's single digits, and you can see prices jumping 2 or 3 ticks at a time. It's jumping entire points. The thing is just madness, right? It's like shooting a pinball on a pinball machine. I think it's all over the place. So this is not helpful on the NASDAQ. We'll go over to the ES. And if you are on the NASDAQ and you want to use the dome, use the micro. I get it. If you're on a 50,000 account and you're like, oh, I can trade the mini. Yeah, I know. But the micro has the most liquidity out of all of these. The ES, the MES, the NQ, the MNQ is the most liquid of them all. So it might be a little smoother than the NQ if you did want to use the dome. That always shocks people when I show them that the ES doesn't trade as much contracts as the NQ, the MNQ. That's the world we live in. So on the ES, if we were coming down into the low and we're looking for that reversal, it's likely that you could see some activity on the dome. Like it could get thin over your head. It doesn't have to, but seeing it is another confirmation that they're clearing the way for a run up, right? It'll start to get thin up here, even if it's just 2 or 3 strikes. It might go from double digits, like we're seeing now, into single digits for 2 or 3 strikes. That's really helpful, right? Because it's showing that they're thinning out what's overhead. So, like I said, you won't always see it, but if it shows up, hey, great, take it. Also, the time in sales on this platform, on TradewithKev, is color coded. So that's helpful too, so that you can see the flow of orders that come in. You're looking for that fire hose of buying, right? Just running over everything in its path, and everything that the sellers are offering is just getting sucked up. It's just taken out. That's usually the explosive bars that we see when we get bear traps, or across the highs when we get those bull traps. And then we flip it over and we crush it, and we get that explosion in the tape. I leave one filter at 0, and then the other one, you got to adjust it through the day so that it's not moving too fast. That would be your mid-size order, and then the 0 is just tape speed. How fast is the tape moving? You can run a third one that is a big lot order, but if you're limited on space, I would throw the big lot order off the tape. I would throw that one out. So you can use the dome and order flow to help with the reversals too. When there is a signal, it's pretty awesome. But if you're on the NASDAQ, the dome isn't going to be very helpful. The tape might, but the dome won't. Oh, we did fibs last week. I went back and listened to the recording because I could not remember and I didn't write it down. I was in such a hurry to go get my bike ride. And in the video from last week, reversals was the topic. I don't mind going into the fibs again, but I kind of feel like we've gone over the fibs. Yeah, I could remember and I asked and nobody answered. So I went back and watched the recording because I couldn't remember. I was so excited about getting the bike out. I could not remember what the hell we were supposed to cover today. So anything can be measured. And because it's so arbitrary that we can measure anything, I think a lot of people get hung up on that. So, you can just make some rules about what you are allowed to measure and what you're not. The basic ones, though, is the yesterday's high, yesterday's low, or only the Globex high and the Globex low. Right? Those are classics. They work really well. And I don't have anything wrong with those at all. And then, of course, the event bar, the like a 830 print or something like that, one really big monster bar, we can measure those too. So on these swing lows, this is something that you really want to add to your system. This is not a very good example of a swing low, but so what? There's our reversal and the move back up. When you get a swing low, these wicks, you can anticipate those wicks because they're supposed to be there. So that question that people have about, okay, we turned around, we got the reversal bar. Do I get in as soon as that bar closes, or do I wait for price to break out of it? What am I supposed to do? Well, if you know that there's supposed to be a wick, why would you get in as soon as that bar closes and the new bar opens? Why would you do that? If you know there's supposed to be a wick, that doesn't mean you're actually going to get one, but you're already telling yourself there's going to be a wick, there's going to be a wick, there's going to be a wick, and the candle closes, the new bar opens. What do? You don't get in. There's supposed to be a wick. We're going to go down. So if you know we're supposed to go down, that answers that question. Don't get in as soon as the new bar opens because there's supposed to be a wick. Now, if you can catch that wick, say, I like to use the midpoint of that previous bar. Say you get in on the midpoint of the body or the midpoint of the bar, whichever works. Or you can even, try to catch these lows. Sometimes I do it. More often than not, I don't because I'm not that good. I can't bottom tick stuff like that. But so now, so what? You're in it, right? And it doesn't make it up and it doesn't break out through the top. So what? You was able to get some. And if these stop you out, you got stopped out in profit. If it ran up and V bottomed and just ran like these other bars did and kept on going, then great. You would have had a nice run all the way up. But even if it fails, it comes up and it hits this and then it drops. So what? You was able to get some and then you defended it and you got another shot later on because you made money. You didn't hurt your account. You will get another chance to trade again later and there'll be another reversal and you try again. Of course, there's a mid bar play here. So once we did finally get through that mid, there was a chance to get long. Or once we broke through the high of the day, there was a chance to go long. We had the previous day's bar here. That's yesterday's high. So that's a possibility of a reversal. Same here. So there's chances to trade later. This one doesn't have to be the make all break all. The candle closes, the new bar opens. You try to get in somewhere around the midpoint of the reversal bar or as it breaks above the close of the reversal bar. And if you end up getting stopped out up here, you made 2 or 3 points. You didn't get back to the high a day like you wanted, but so what? Defend the trade, get out, look for another opportunity later. The problem with that logic, because there's no great answer to trading, right? My way is not perfect. The problem with my way is if you defend a trade and you only make say 3 ticks or 1 point, but you had risked a 3 point stop, now you risked three to make one, right? That's not good. So there's always a handicap for anything out there. There's always a handicap. That's the handicap with what I'm laying out here is that if you defend the trade and you get out without reaching your target profit, your profit may be less than what you were willing to risk. Therein lies the problem. But I rarely take a full stop. So my risk might be a 3 point stop. I rarely ever hit that 3 point stop. So what's the alternative? That you was aiming to get way up here, and if it doesn't get way up there, you're just gonna let yourself get stopped out and lose your 3 points, 5 points, whatever you was risking in the first place, just so that you can have the proper stats and make it to your target? Not me. For every level that we've got in price, we've got to ask, how did we get there? Now, I could just draw the lines right at the high a day, but start with the breakout. This was the high, that was the low. We ran back up and we broke out and rejected on the 111. Now, once we start coming back in, a lot of times I move this drawing because I need to know where the real midpoint is, right? Now, sometimes I do just this, just like I did, because I want the absolute real midpoint. And that's this level right here. But I don't like to leave it there because I don't like this, right? So once I've got that, a lot of times I drop it down and I put it on the body. It's not a perfect system. I wish it was, like I wish I could just say I just always leave it like this, but I don't. So I'm going to put it like I normally would. That white line is the real mid. And if this was to keep falling, that real mid is what I would be looking for. So now we're jacking around here, failing to get going. 786 is holding true. It kind of validates for me that I have my drawing in the correct spot. Now we get a breakout and we run up to the 1, 2, 3, 6 and we get an OCC. Perfect. I guess I'll just update my drawing here up to the body. Now we've got a 111 reversal and we're stalled out right there against the high of the day. It's against a big round number, the roundy. We pull back. Now at this point, just like before, when we stalled out like this and we start to fall, I need to know where that real mid is so I can bring my drawing up all the way, which is fine if you guys want to do it that way. There's nothing wrong with it. It's easy to remember, right? Just take it to the high, always. Just take it all the way. But I'm going to do me, put it where I normally do. There's the 786 reversal and another shot at the 1. So remember, you got to understand how price got to where it got to. That way, you've got a better idea of what are you going to do with it. I like to think of it the way it was talked about in the Fibonacci books, where it talks about you have all these buyers and then people take profit. But we don't want to see everybody leave. We just want to see that some people are leaving and others are willing to take their place. In the textbooks, they say people should be willing to take their place before price gets too deep. Because where's all the enthusiasm? Like where is everybody? So that 786 for me is where I expect the new crowd to come in. All those people who are waiting for a pullback, they finally got their pullback. Because there's a lot of people with rules that say, I'm not going to buy the high, but I'll buy it on a pullback. Well, there's their pullback for those traders. I don't want to be them. I don't want to buy the pullback, but they do. And I want to see that they do. And that's where that 786 comes in. So as long as we're still holding above 786, there's still the possibility that we're going to come back up to 100. I don't know if we'll go higher than 100, but I know if we're above 786, 100 is on the table. And if we get below 786, then 50 is on the table. Yeah. So there's another shot at the 111 and it fails to get there. This would probably be a time where watching the tape would be useful. Look for a bunch of really big orders up here that wasn't willing to move. Look for the tape to just turn a sea of red and be hitting really hard and really fast on that reversal. Try to spot the sellers as they hammered that thing back down, because that's what I would have wanted to see up against that level, right? It doesn't look like they were defending way up there. I mean, don't get me wrong, there is some volume up here, some elevated levels, but how do we know it wasn't from these earlier in the day? I can't tell from here. On TradingView, you could come in and then, back up to before these candles were here and see if all of this volume came from just this amount of time, all of these candles. Or you could turn off the Globex and then just see the regular trading hours and how much volume you got against that level. See if those sellers really did defend it or if buyers just got exhausted, because you could probably see that in the volume profile. But doing it the way I did it led us up to where we are and shows us where the 111 is and shows us we failed to get there. And then that's also a 3-bar reversal, even though it's a micro version, because it wasn't like a beautiful run up and then we got that. There was all of the drama along the way. So it's not a really good 3-bar. I just pointed it out. And even if we didn't walk it up that way and we instead just did this, you can see the 786 holds into the close, at least right into the 4 o'clock. Then it broke down. 4 o'clock was actually right there. So it held till 4. When you're trying to take a trade, if you understand or have a narrative about how price got to where it is, it helps. Also, I like to take a trade when I can see it coming. I don't like trades that surprise me, right? That's why I like trading yesterday's high and yesterday's low. we have all day to wait for price to get to that level. You can see it moving towards that level. Like it doesn't sneak up on you. So it makes for a really good trade. This 100 right here is yesterday's high. I know it doesn't seem like it, but yesterday's high is way back here. So we had this whole run up for me to be looking at yesterday's high. I knew exactly where it was. It didn't sneak up on me. Of course, I wanted a 111. So I was not trying to trade this reversal here. But if that reversal had been the 111, oh, well, that would have been awesome, right? That had been perfect. But that's the idea. It didn't sneak up on me. I don't trade it if it just suddenly shows up like, oh, dang, where'd you come from? I don't trade those. Hey, you made it back, huh? All right. So the low of the day, the MNQ, we can measure all of the Globex from yesterday up to the Globex high of yesterday. And in the regular trading hours, when we broke down, you can see exactly what we got out of it. Now, I'm going to put this line where I normally would put my line, right? This is not how I would normally do it. So we'll just back it up and you can use this one or you can use that one. Either one. I'm going to use that one, but honestly, either one is fine. Yeah. Just stick to the lows. It'd be just as good. There's a failed attempt to reach the 111. But even if you didn't do that, you had the low at Globex, price reversed at the low at Globex. So the idea of anticipating the reversal, we were at yesterday's low. You should anticipate price responding at yesterday's low and yesterday's high. In this case, sorry, it wasn't yesterday's low, it was Globex low. You should anticipate it. That's what we reversed today, right? We went up today in the ES, and what did we hit? Yesterday's high, and we stopped on a dime. Like that should be a big part of your day to day anticipation is that when price gets to yesterday's high or low, or the Globex high or low, that we have a fight and that we might not make it through that level. For yesterday's level, I was marking Globex there. Let's do all of yesterday. Shoot, I'm 2 days. Yeah, no, that's right. Marking Monday for Tuesday. So Monday's high, Monday's low, Globex reversal 111. Now on that one we overshot, but we didn't make it to the 1236. Remember, it's not just the lines, right? It's having an idea of what's going on in the market and why should we be expecting a reversal. If the market had ran all night long and then it really started to get extreme and then it built this base, it showed that it was trying to reverse right there, right? With that little bit of a base. That's my failed flag play. And in that failed flag play, checking the 786 is usually what we get. It tried that, it failed. It tried it again, and it failed even deeper. But we were still putting in a big old base, a big old flag down here. And sure, it's a bear flag, but it was a bear flag failure. So you want to try to walk into where you find price and then where do we think it's going to go next? That works out relatively well for me. You can do an either or, right? There's nothing wrong with it either or. So you lay out your lines and you say, okay, if it breaks below this, we're going lower. And if it breaks above that, we're going higher. that does not mean you trade it. That means you've got targets, right? So look at what we've got now. Forget that it's 3:45. Imagine it was 11:30, right? It's 11:30 in the morning and you've got all of this. If it breaks 786, we're going to the half. That's the destination. It's what is that? About 115 points. Somewhere in that 115 points, surely you can get 20, 10. So you don't have to get in as soon as we break 786. You just want to start looking for short opportunities once we do get under 786 because we're going to the half. And yet, if we was to run back up and we break 100, where are we going? At least to the 111. We're going to check to see if that breakout is real. And if we get through the 111, we're going to the 1236. And that's a 40-point range. Surely you can get, 8 to 12, 15 points in a 40-point range. You don't have to get in as soon as it breaks through 100. Just after it gets above 100, you already know we're going for the 1. Now, that's an either or, but it works. You could have anticipated the reversal. We didn't get a good one here, not like the images that we looked at earlier today. That's a really good 3-bar right there. And it's at the right spot on the day too, right? We ran back up. We got into the distal line and the proximal line. And we got that really nice 3-bar reversal right there. That's a good one. So when you can put all the pieces together, it helps, right? The order flow, the tape, turning at the point that it's supposed to turn at, all of those can add that conviction, the trust. But for the trust to really come, it's your ability to read what's going on, to recognize the pattern from the work you've done in the past, and be convicted that you understand what's about to happen next. That trust is where you'll really start to shine. Because if it starts to fail, you'll already know, like, hey, you're not supposed to behave that way. That is not how this trade is supposed to go. Hey, screw the stop. You just get out because it's not doing what it's supposed to do. But the only way you would ever know what it's supposed to do is because you've looked at it in the past and you've studied it and you've got a really good idea of what failure looks like. Like, what does it look like when the trade begins to fail? And you're like, oh yeah, I know what failure looks like. Great, do that. That's a nice check on the mid. 111 failure. Check on the mid again. Remember, we can measure anything. Now, I know traders who are at it all day. They're taking, 20, 30, 50 trades a day. I have done it. I don't want to do it. I don't do it anymore. It's not my style. I am patient and I'm picky and I'm willing to wait all day because, like we talked about a little while ago, I'm here. I don't care. And I got most of my trading done in the Globex. So I'm very picky. But you can be as picky as you want, right? What I think you'll find out, though, is the ones that you can better identify, the ones that you can play out better, right? Because if there's no pattern like this, I can trade it. Of course, but I don't want to. There's nothing good in there. Yeah, we can mark the mid of this bar and it's got the turnaround and you know what? Yeah, it's tradable, but I don't want to trade it. It's junk. Yep, I am a swing trader too. I don't do much swing trading in the current environment, but yes, I am also a swing trader. To me, this environment for swing trades right now is not a good environment. There's some good themes, but a lot of them are so extended that you got to wait for the themes to back off a little bit. And they don't even want to back off. They're just pushing and pushing and pushing. Yeah. I've shared a book by Gerald Appel that talks about the optimal time to swing trade. And I was thinking about that again this morning. Um, I'm very likely going to go into the past. Gerald Appel, he's the guy that is attributed to making the MACD, right? This is a MACD. If we click the little question here, a lot of times they'll use his name. They didn't give him any credit here in this one, but he's the guy that most people say created the MACD. Well, in his book, he talked about when is the optimal time to be a swing trader. And that's when you can follow the indexes, right? When 80% of the market is doing what the indexes are doing. And what he laid out was really simple. If the Fed is giving forward guidance and the S&P is above its 50 and its 200, then you should be long the broader market. And then you can just pick and choose whatever stuff you want to go get long in. Housing, oil, commodities, whatever, right? You just go get long in all that stuff. Well, we don't have that. We don't have the Fed providing forward guidance. Sure, the S&P and the Nasdaq are above their moving averages, at least the 200, but that's about all we've got. All this really simple criteria he laid out, and we don't have it. And without that forward guidance from the Fed, we got a choppy, violent, disgusting market. Then we're in this historic change, right? Like going the from boats to railroads or from boats to carriages to cars to railroads. Big changes. AI is changing the world like automobiles changed the world, like the internet changed the world. This is massive fundamental change, and it's got to work its way through the market. And that's going to break so much stuff. It's not a good time to try to swing trade. Doesn't mean we can't do it. Shorter term swing trades. But if you're just looking for solid, consistent behavior, we don't have it. So my swing trades have cut back a lot. Instead of having 300 to 500 trades, more often than not, I've got 75 to 100, maybe 130 trades. Way back. There's no reason to fight the Fed, and there's no reason to fight a market that can't even figure out where it's going. You've got 50-year veterans right now who are all in disagreement and have no idea what the hell the market's going to do. No idea. And if they can't figure it out, bet I'm not going to have it figured out. There are some good themes, though. They're just all way outstretched. This is the way that I've got things broke down right now. Um, Diversified exposure. These are the non AI type stock plays. Only these are ETFs, right? It's just the easier way to go. But these ETFs avoid AI. These are targeting AI. The military defense, I had this before the war. This is not about the war. It's actually about the lack of materials for the military to be able to make things. So there's the military defense list, and then there's the space economy list. I have a quantum list. It's just it's not in here, and that's because quantum's really taking a backseat at the moment. And there's a drone list, and I've got more than this, but these are the ones that are hot for me right now that I've really been paying attention to because we rotated out of the AI stuff into the diversified stuff. And now it looks like we're about to rotate back again, but we haven't rotated back again. So, of course, you got healthcare. I mean, this is going back to last April, right? 2025. So 1 year. That doesn't look that bad, right? We spent half the year underneath that midpoint, and then we got up here and we just been kind of stalled around that 50. And medical devices, it's a tangent play, but it's not AI, right? It's more AI device. It's the robotic surgery theme. They're using AI to assist doctors, but it's not targeting AI like oh, cloud and data centers and all of that stuff, right? So it's just another way to play the game. Arc Genomics, this one's a lot more risky. Anything with Arc is more risky. Specifically targets companies that's using AI to code DNA. That's why it's risky, but it's still holding above that 200 period. Industrials, XLI. Look at that beautiful chart. We got stuck here for a while, right? From like August all the way into the new year. But the wider the base, the higher in space. That's one heck of a base. This one has GE and Caterpillar, and both of those companies are using AI for predictive maintenance and autonomous heavy machinery. Gotta love it. That's pretty cool. I do like Caterpillar. This is robots, BOTZ, artificial intelligence theme, like ABB and Franck, arms and legs of the AI in factories and logistics. So if we look at my notes, these exclude the top 10 stocks, like your Mag 7s and stuff. And then you got your infrastructure, defense, power demand, healthcare, AI adopters, the spread it out because global markets are doing better than we are, Eurozone, emerging markets, and Japan. And then your defense plays, if you really want to maximize them and get into the risky stuff, IHI, the ARC, Genomic, get into some Asia Pacific with the VT. You could just run VT, do like a total world stock. Infrastructure looks really good, except for this really tight consolidation right here. It's starting to scare me. We're winding up for something. Emerging markets, gappy booger. The Eurozone, EZU. Japan, EWJ. So that's the utility and defense group, the or the diversified group, I should say. And then of course everybody's got their AI targeted group. This kind of lays it out. You got the Qs, SOX, SMH, Taiwan, Korea, and then you got to have energy to push all of that. Your uranium and nuclear energy, and then the old school fight versus the application and data. So yeah, I'm swinging, just not much to swing. Transition happening, no forward guidance from the Fed. These are all nasty. They're just don't play options on this stuff, right? Um, Korea defense industry. And look at that blow off top. Shipbuilding and manufacturing constraints have led to partnerships with Korea's um, Hyundai facilities, aerospace, defense, supply chain de-risking. That gets into the military having the right rare earth minerals and strategic metals, uranium, and that sort of stuff. It is not the same crowded trash that everybody else is playing, that's for sure. Hey, we were talking gaps. We got that weekly gap down here that needs to fill. We'll see how it goes, huh? Yes, it will. I've been wondering if it was going to happen before OPEX, and yet we keep getting closer and closer to OPEX. And like maybe we're not going to reach it after all. I hope. We got to get out of this range. Just like it's going forever. Someday we're going to get out of this range. Someday. we're definitely gonna get it, but I think you're right. I think we're gonna get it, and I'm gonna say, "Oh shoot, that hurt. We should have stayed in the range." But even if it's a quick wash, I think the market really, I think we might go down and get that quick wash, and then come out the other side even stronger. That's what I'm hoping. Yeah, because a lot of analysts are talking about 800, right? And that's all the way up here. And if we're going to 800, then all I keep thinking is we need to be able to Busby off of something, right? So we build this strong base and then we shoot up to like 740, maybe 750. And then we come back and we check that and we get that Busby off of that. That might be too high though. Maybe we get into like 720 area and then Busby. See, that's why I think that this lower level is going to get hit because SPY going down to 650 should allow a lot of those equities to get those gaps closed that are lower. If we can get a fast, sharp sell off through the midpoint of that monthly bar that I've got marked right here, then we could drop down into 650 sharp and fast, get a quick sell off in the indexes and in the equity market, and then come ripping out of this thing and finally get that breakout. Yep. That 200 is coming right up into that weekly gap that I've got marked. We've got uh, a lot of the futures markets by the 13th of next week. It's going to be the last day that we trade the March contracts, and we'll be swapping off to the June contracts, the H series, I think. Maybe we're on the H. No, we're not on the H. But we'll be swapping over to the new contracts next Friday. Well, next Friday will be the last day. We're on the H now. We'll be on the M next for June. And there's still 50-point spread between those two. So the market is bullish into June. There's just so many things that are broken right now, that are that just changes that we haven't seen in so long, like Japan. Um, that one thing all by itself. And then the no forward guidance from the Fed. That's such a big deal. Swing trading is so much better when you've got forward guidance. So what I was thinking about this morning that I thought would be really cool is if I go in on something like a SPY chart, set it to I'm thinking like maybe 5 years, and I'll probably use TradingView because TradingView can not TradingView stock charts. I think stock charts will give us a better look back of all 5 years. And then I mark out when we had forward guidance from the Fed and when we didn't. And then we can chart that time period and we can look at equities within that same window and show how different the market behaves when it knows what the Fed is going to do. Because when we're on autopilot from the Fed, it is such a different market. We don't get those shenanigans that we had, say, like last year in October, November, and December when they were unwinding a rate cut and then pricing it in and then unwinding it and pricing it in. All of that drama was from rate cuts. So that's just one area. But then we've had everything, right? Actually, it was this time frame. I was back 2 years. October, November, and December, right there. All of that violence was from rate cuts being priced in and unwound in the market. But when you add Japan to it, and the now we've got the potential for a lame duck presidency because this president can't run for election, and at some point they're going to just start to ignore him. That is going to happen. It's not because of who he is. It's just because that's what they call it, a lame duck presidency. He has no impact. So he'll be done. And then what? Right? Then it's going to get even worse. And we don't have the forward guidance. We got Japan doing something new. And if that's not enough, we've got AI cannibalizing all of these software companies. So everything's just so dangerous. Yep. Yeah. All of that weighs on us trying to get swing trades. And if we're rotating out of a growth to value phase and getting into a value over growth phase, then that is one more check mark against a good, stable swing trade environment. So it just makes it really difficult to do those kind of trades. There's also the old adage, if you can't find a good swing trade environment, just get long in the indexes. And don't get me wrong, when I've tried that in the past, the rewards was not like a 6 to 8% or 12 to 14%. It was more like a 2 to 3% return. And you can get that from just a CD. You can just go buy a CD and call it good for the year. And that's why it's not worth it, right? If you're only going to get a 2 or 3% return and you're taking the risk of just going out and buying the cues, you might as well just go get a CD for the year. Well, I mean, if you got a $500,000 account and you want to make 2% on a $500,000, how big is that iron condor going to be? There's the idea that you can at least make the S&P's average returns, right? Because all you have to do is just buy the S&P. The average returns 11%. I don't even think it makes 11. What's it getting? Like 7 right now? So if the S&P is going to be sideways and the markets are going to be sideways, and then you go and buy the SPY and you're not even making 7% return, you're making like 3% on the year. That's the idea, right? Of the argument between just buying SPY and holding it all year and making 7% or trying to trade and make more than 7%. You might as well just get a CD. Fixed income can give you a 6 or 7%. Yeah. So that chips away at the argument of even just owning SPY for the year. Yep. I would like to flush down into that 200, maybe overshoot it and get an amazing reversal bar down there and then just come ripping out of it on the other side. That would be fantastic. In COVID, I remember we were talking about reversals every day during COVID. Just we just kept waiting and waiting and waiting and waiting, looking for that day that we were finally going to get the reversal. And we got it, but it was in a stage, right? It wasn't like one single bar, one day, one time, and then away we went. The intraday price swings back during COVID, we were hitting lock limits. The futures would travel more than 7% in one day and was locking up in lock limits. I just marked one SPY candle and it moved 6.13% in one day during COVID. Those were not easy times. I can attest to that. I was right there in the thick of it. Those were wild days. These bars don't look unusual at all, right? Because there's no context to them. This bar, 6.5% move in one day, 8.1% move in one day. That was a lock limit day where the market froze and locked into place for 15 minutes. From yesterday's low to the next day's high, almost 12% in a 24-hour period. They were violent days, very trying times. So it was difficult. But for anybody who was trading back then, what we have now is nothing. Is like riding bulls and then going and sitting on a cow one day. It's just not the same. So a good flush, get down into that 60-50 area, maybe even, 60-30, 60-40, get that reversal we're all looking for. and then come out of it, that would be really nice. Yeah, I'd be down for that. There are some um, options tactics that we can go into on Friday for using options in a swing trade rather than using stocks. And in this scenario, we'll use options for the indexes like the Qs or the ETFs, because I am a big fan of using ETFs. So we'll go into those. We'll go through these calendars, poor man's covered calls or covered puts, diagonals, risk reversals, broken flies, and ratio flies. And maybe the, yeah, Austin, we can certainly do that. Um, because for the most part, yes, but in some ways, no. For me, liquidity is a really big part of what I do. And when I can't find the liquidity, which is my problem with things like the Russell, it just doesn't have that liquidity. And the Dow is even worse, right? Like it's real bad. Oh, yeah. When it comes to patterns, patterns are patterns are patterns. It doesn't care if it's Tesla, IWM, Nat Gas, the VIX. It does not matter, right? And what you missed earlier, and hopefully you'll catch it in the replay, is the only way you're ever going to trust these patterns is if you do the work. And I went through what that work looks like in the video. So the only way you're going to trust it for equities and for SPY, Qs, IWM, and stocks is to go back and do it and prove it, find it, and show yourself that it really does work. Otherwise, you're never going to believe it. And you shouldn't, right? Like you're the only one that needs convinced, and you're the only one who can convince you. And without that trust, you'll never trade it right. You'll get out too soon, you'll hold on too long, you'll second guess and make all the wrong decisions because you don't trust it. The only way you're going to get that trust is to do the work that I covered in the first part of the stream, and then you'll have it. But when it comes to patterns, a pattern is a pattern is a pattern. So it will always work, right? And you can validate that, which is the best part of trading, so that you don't have to second guess it. Yeah, but I've used these same patterns on, Caterpillar, Tesla, because price is price is price, and it doesn't matter, right? It's really funny. There was trading back in the 1800s in banks, right? Banks were like tech stocks back in the 1800s, 1700s. And of course, they didn't use candle charts back then, but the ledgers still exist. And if you was to go back and chart out the ledgers of when something was bought and when it was sold, it forms patterns. The same patterns we all know they existed back then when nobody could see them. The patterns are always there. They always were there. They always will be there. Yeah, when I first got into the Bullish Bears, maybe 10% of the Bullish Bears traded futures. Everybody else traded stocks and options. But when I got into the Bullish Bears, there was no micros. There was only minis. And there was really only one broker that you could trade minis on in a small account, and that was Ninja. And that small account was $500. You had to have at least 500. And back then, most people recommended that you started with 1,000. But they were so unknown that everybody was like, well, I've only got a small account. I want to trade leverage. I guess I'm an options trader because what else are you going to do if you want to trade leverage with a small account? So most people who joined went to options. And then we got micros and we got more brokers that allowed small account trading, which means you didn't need, the big margins that the other brokers needed. Trade of Eight, Iron Beam, Infinity, all these brokers started popping up and a lot more prop firms. So now new traders show up and they don't want to risk a lot of money or they don't have a lot of money starting a small account and they go to the leveraged product that is less complicated than options, which is futures because you don't have to learn the Greeks. There's no decay. It's not multiple contracts going in different directions. So a lot of people gravitated to futures, and now 75% of the Bullish Bears community trades futures. But we're still here, right? The stock guys and the options guys and gals, we are still here. We're just not as vocal, but we're here. And in these poor environments where I don't want to put a trade on, there, like we were just talking about, there's no good swing trades that I want to jump up and down and shout out for everybody to trade. With my money, I'll take some risk in it because I'm willing to lose my money, but I don't have the confidence in what I'm seeing to give a shout out. So a pattern is a pattern is a pattern. If we call out a reversal in the ES, that means it's a reversal in SPY. It's also a reversal in the QQQ, and it's a reversal in IWM and DIA. Not as tight today, but one, they're all green. Two, a lot of times the change percent will match. So you'll have, SPY up zero point 0.7 with the QQQ up zero point 0.7 and the DIA like zero point 0.8 or zero point 0.6. So it'll be a little off. And then IWM is usually half of whatever they move, but they're all green or they're all red. So when you see someone, shouting out that oil's long, well, then so is USO. Or, you know, copper short, then great, there's an ETF for copper too, or copper stocks or copper mines. if they're trading the ES or the NASDAQ in the QQQ and SPY, you could trade the same thing. So the chat might be futures, but stock trades and options trades can trade off of what is shown. All right, guys, let's wrap it up. We got a list for Friday, so we're going to get into those. This list here. And I'm sure we'll have time. So once we get through that, if there's something else we want to cover, we'll get into that too. Um, a lot of these can be run in a market where we're just not sure what we're going to get, and that's the idea, right? That's exactly why we want to focus on these rather than directional trades like buying a call or buying a put, which commits you to a direction and a destination. These don't. That's what gives us a little bit of edge, right? Is that they're not committing us to a particular direction, and we can kind of play both sides of the fence. No, no worries. That's why we record it, right? Always feel free to ask questions. Everybody, have a good night. We'll see y'all in the morning.